Let's get Mike's buyout out here. So let's introduce Mike Flynn for a second. Mike is the founding member of one of the original advisor-friendly, unbundled. So he's going to explain this. So let me say this again: advisor-friendly, unbundled, custodial agnostic. Do I have to spell that in a sentence, Tiffany? Independent trust companies in 1991. Mike has over 30 years of dedicated service and experience. Mike helps dispel the often misunderstood myth that irrevocable means immovable by identifying the steps required to move a trust and the relationship between the trustee, the client, and the preferred financial advisor. Please help me welcome Mike Flynn.
Walter, thanks. Pleasure to be here.
Yeah, and what our audience doesn't know is he's an amazing tennis player. So you got that going for you, and I know you're always trying to recruit me on the doubles team, and I always kind of let you down, but you're multi-talented.
You're too busy working with high net worth families and making their lives easier.
Well, Mike, talk to me. You were such a great speaker for this, and your experience. You got 30 years in the trust world. 30 years of seeing families do it right, they do it wrong. The debate is, should we have a corporate trustee? Should we have Northern Trust? Should we have the bank as trustee? Should we have the son? Just kind of give the overall kind of
Sure.
A to Z, just is what families are thinking about.
I always like to start with the example for families. It kind of goes back to Indiana Jones and one of the movies when, he was searching for the Holy Grail, and the Templar Knight who was in the cave, looked at him and said those famous words, "Choose wisely." And of course, we know what happened to the Nazi officer who didn't choose wisely. And I've seen that happen in many family situations, and the dynamics that can exist within families. You were talking about it earlier, the dysfunction when individuals and often family members are named as trustees and successor trustees in estate plans. So it really starts with a very fervent consideration of who do you want to step in, if not only if you pass away, but certainly if you become incapacitated. Just in the last, as we all know, in the last several months with the COVID pandemic, I've seen a massive amount of conversations and movements with advisors I work with across the country from their clients who, after the market tribulations, the what's happening to my portfolio, what should I do? The conversations quickly turn to, geez, what happens if I'm intubated? I get COVID. What happens if I die? Who should I be thinking about for a trustee? Would you be my trustee as my advisor? Should I name my son, my daughter? Should I name my brother, my sister? So this is a very, very relevant topic. And obviously the COVID pandemic, I think, has escalated it to the top of a lot of conversations families are having with their trusted financial circle, including their advisors, their estate planning attorneys, their CPAs. And this filters down to what I do and really partnering with folks that manage assets, manage money, but most importantly, manage relationships and expectations with clients on the financial services side. So, from a fiduciary standpoint, and from a trust and estate standpoint, I think it all starts and stops with that, because if you can't find or you can't identify a suitable trustee to step in for you, if you are incapacitated, you have a stroke, you have Alzheimer's, you have dementia, you're intubated, and or if you pass away, if you're abducted by aliens, as I like to say, having the right person be able to step in and do the things that a trustee needs to do is very, very important.
Talk about the different types of trust companies. Are all trust companies the same?
So it's a real good question. So I like to split the role of trustee or successor trustee, which is what we talk about a lot, Most people, when they create an estate plan, they have a living or revocable trust where they're their own trustee, or they and their spouse are their own co-trustees. So what we talk about a lot is successor trustee, next up. And again, I split that into individuals versus institutions. Brother, sister, oldest son or daughter, most reliable son or daughter versus bank trust company. And when we do a dichotomy then on the institutional side, I split it up into traditional versus non-traditional. And as you said, I had the privilege some now 30 years ago to help establish one of the first, that long-winded description, advisor-friendly, custodian-agnostic trust company. What does that mean? It means an institutional trust company in a sense that doesn't do what traditional bank trust companies do and what most people are familiar with, namely physically custody assets, namely manage the assets that are in the trust account, and namely be the primary relationship manager. So in the unbundled world, unbundled advisor-friendly trust companies allow the family's preferred advisor, somebody they've been working with, somebody they trust, somebody who's been managing their assets, somebody who they'd like to be there as a mentor for their next generation, for their kids, somebody who they'd like to continue to manage their assets if they are incapacitated, if they have a stroke. So this unbundled advisor-friendly trust company paradigm is best described, I like to think of it as a table with four chairs, the table being the trust, chair one being manage the relationship with the beneficiary and interested parties. Again, that's the preferred advisor. Chair two, manage the liquid assets in the trust, the stocks, the bonds, the mutual funds, the ETFs, the cash. Again, that's the preferred advisor. Chair three, where is that account opened? Where is it physically custodied? Where is the trading and settling occurring? And again, in this unbundled advisor-friendly paradigm, it's on the platform of that preferred advisor's choice. So it's business as usual for them. Chair four then being the traditional trust administration. This is what I like to call the blocking and tackling of the trustee world. What does that mean? Interpret the trust. What were the grantor's wishes? Do the principal and income accounting, which trust accounting and trust administration requires. File the taxes. Make those discretionary distribution decisions that the grantor has built into the trust. The health, education, maintenance, support, or HEMS provisions. Send out the statements. Those are the traditional trust administration rules. In the unbundled world, that unbundled advisor-friendly trustee performs versus the traditional bank trust company that's doing it all. And these are the bank trust companies that we all know. They've been doing it for decades and decades and decades. They do everything. They manage the money, they custody the assets, they do the relationship management, they do the trust administration.
So let's kind of walk through a scenario. Somebody has a legacy asset. Let's say they got a mobile home park. Do all trust companies, or they got an interest in a closely held business, so there's some element of complexity. Do all trust companies deal with that in the same way, or is there a desire with some of the trust companies to liquidate those assets and then bring them into the management of their shop?
It's a great question. And again, several answers to that. So again, most larger states, I say larger, as you start to get into the 15, 20, 25, 30 million and up estates, are going to have things other than traditional stocks, bonds, mutual funds, ETFs, and cash. And again, this is another reason why institutional trustees can provide a lot of value to families as successor trustees versus individuals. Family members, individuals often don't have expertise with oil, gas, mineral rights, LLCs, family businesses, subchapter S, et cetera, et cetera. Now, that being said, again, the traditional bank trust company often has a motive to sell those and create liquidity, and then it often raises their fees. It's less complicated. So again, depending in terms on what the provisions of the trust are, what liquidity does the trust have, a trustee in their fiduciary capacity has to make those decisions. Whether or not that, if you will, illiquid asset or non-traditional asset can remain in the trust. Does the trust stipulate it has to stay in the trust? The trustee's not able to sell it. Does the trustee have discretion? So a trustee then has to weigh out, is that non-traditional asset, that privately held limited partnership, that LLC, is it producing income? Is it producing enough income? Is it a prudent investment? for the trustee to hold for both the current and future beneficiaries. So there's a lot of conversation that goes in there. And again, an institutional trustee is going to be able to bring the expertise and bring the knowledge to be able to evaluate that, and often to be able to administer it, because it's going to take administration if it's oil and gas, if it's rental property, things like that.
Well, you bring up a really good point, because I've read so many trusts. Read one recently, and it was, okay, when mom dies, I get the stuff, and then when I die, liquidate it and give it to my daughter. Well,
Yep.
On further investigation, they had these great assets. I mean, I'm a proponent, and that the kids don't need cash, or the heirs don't need cash. They need income. They need a reliable source of income. We talk about it in the beginning of the class, money in the mail, and they had this amazing legacy real estate asset that they had earmarked to be liquidated. And once that was identified, that was just something that was missed. So in your discussion about what does the trust say, I think is a
Right.
great item, where we're in a state and wealth transfer that everybody needs to pull their trust out and really read it line by line, because a lot of times they're created years and years and years ago, correct? You probably...
Absolutely.
And they're very...
I just did one today that was created in 1947. Another one that was created in the late 60s, where, income rates on bonds was 8, 9, 10, 12%. And the trust talked about, distributing income, when of course we know in this environment, in order to get 8, 9, or 10%, you're investing in Dewey, Cheatham, and Howe bonds. So, it's that environment just doesn't exist.
Wow, Mike, I hadn't even thought about that. But if you say income only, then what happens?
Correct.
If you say income only.
So again, yep. Yeah. So what we're talking about within a trust is what are called the dispositive provisions. So a trust will have dispositive provisions. Those are the directions to the trustee as it pertains to distributing to beneficiaries. Those dispositive provisions, keep in mind, are just a set of instructions. People need to remember, all a trust is a set of instructions that's basically detailing the grantor slash settler slash creator, those are all interchangeable terms, creating their wishes. It's then up to the trustee to make sure they're interpreting those wishes correctly. And if those wishes say, all I want you to do is distribute income to my spouse, and then when my spouse dies, the principal goes to my kids. Now, if that was created back in the 60s or early 70s, the grantor's looking at 10, 12, 14% on treasuries. If they haven't looked at that trust in 50 or 60 years, no one's made the change, and we're now the trustee, and income rates for safe bond investments are 3, 4, 5%. Well, are the grantor's wishes being executed that his spouse is, instead of getting 10, 12, 13, 9%, they're getting 2 or 3? That makes sense?
Yeah, no. And so then all of a sudden, the intent, because it was written so long ago, wasn't reviewed. Somebody passes away and they're left with the language of the trust.
That's correct. And that's why, as you mentioned, it's important for grantors to take a look at the trust, take a look at what they've put in there, because often when they talk to a drafting trust and estates attorney, things may not have been communicated as they thought.
Yeah,
they need to go back and look at it.
The other thing that I see is that attorneys have their own bias, and they put things in that aren't necessarily the wishes of the family. It's an agreement, and they draft it, and people have this view, just give the kids the money. Well,
right.
What happens when you send 25, 30, 35-year-old, 40-year-old $5-10 million versus transitioning maybe an existing portfolio with an existing advisor and an existing structure? That continuity is way more seamless than a total liquidation and a restart. I mean, do you see that a lot, Mike, where things are just purely liquidated and there's a big restart? Mike, did we lose you?
I'm back. Yeah, I got a little unstable internet connection coming from home because everybody, when they gets home from work, hits their internet.
I just asked you an amazing question. So good, I
Well, just
forgot.
paraphrase. You're good at that. Paraphrase it.
No, I just wanted to know. I mean, because I really want people to go back and look at the trust. I want them to read it, take
Yep.
it out. It's like one of the things that you do that you just don't want to do. It's one of those maintenance things.
Right.
It's like super important that you're always going to get to tomorrow. So we had the health and wellness expert on early. You know, go get your levels
Yep.
checked. Get your trust out, read it, make sure that it says what you mean. Take it to your professional and say, hey, does
Yep.
this still match what I want? So my question was, do you see situations where people, everything is just liquidated and they start all over again unnecessarily?
When you say liquidated assets or liquidated from their documents and starting from scratch?
Well, just liquidated. They have good assets and they're sold because unnecessarily in the trust document, the language reads just
Correct.
sell the home, sell the real estate, and then give it to, I'm not going to name any names, Northern Trust.
Yeah.
Give it to them, and then they can just do what they do.
And that's exactly right. Again, as a grantor, when you're putting this together, if there are certain assets, certain things you own that you want those assets to remain in trust, you don't want to give an institutional trustee or an individual trustee the ability to sell them. You can stipulate, I don't want you to sell this business. I don't want you to sell this oil and gas. And you can put that in there, and it then basically puts a wrapper around that asset that doesn't allow the trustee to make that decision. So I do believe, and this goes back to making sure what you want is indicated in the trust, this, as well as looking at your trust. Do you have a family advisor? Do you have somebody you want to continue who you've been working with, who understands you want to hold this asset, or you want to hold that asset, or you want to own these types of stocks? It's important that that advisor be identified in your estate plan. You don't have to name an institutional trustee that will carve out or remove or kick your preferred advisor to the curb. This goes back to that open architecture that many people and even some drafting attorneys don't know exists. That if you have an advisor you want to continue, if you have a stroke, if you have Alzheimer's, when you die, you can name them in the document. Very, very important, as well as stipulate. I've seen trusts where it says, don't invest in any U.S. Treasury bonds. I've seen trusts that say, I only want to invest in growth stocks. I've seen trusts, you can name it. That's the beauty of a trust. And as the settlor, you can outline those types of things that you want to happen with the investments.
Okay, last question.
Sure.
Give us the dangers of the family member of the trustee versus the corporate trustee.
Yeah. And there are many. And again, it goes back to the choose wisely. And in my nearly 30 years, I've been on several phone calls with mushroom clouds and with brothers or sisters who are promising their dying sibling that, I'll be the trustee for your kids. And, fun Uncle Mike isn't fun Uncle Mike anymore when I'm the trustee dealing with my nieces and nephews. The challenges, again, I think probably start with unfamiliarity, lack of expertise, not knowing what you're signing up for when you tell somebody, I'll be your successor trustee. Number two, it starts to get into the familial agendas. Who likes who better, or a husband and wife that name their second son as the trustee for his siblings, their other kids, because their youngest daughter, is a wannabe actress in Soho, and their oldest son's a ski board instructor in Vail, and their middle son's, a CPA. So, we'll just let him do it. We can't give the kids the money. And now, again, you can imagine the family dynamics that creates when you've got people that are in that situation. Corporate trustees, institutional trustees don't get sick. They don't go on vacation. They don't have familial agendas. They have the expertise. And for the most part, for the money that a corporate trustee charges for its services, it's a no-brainer. It's a situation where you're putting the right people in the right place, and coupling that with the type of situation where you can maintain your own preferred advisor is a win-win-win situation for everybody.
You crack me up. I bet the snowboard example was a real real example that you.
I'm not going to tell. Like I said, 30 years. There's a good chance that I came across that one recently. So we'll just leave it at that.
Got it, Mike. Thank you so much. Maybe someday I'll see you on the tennis court, you know, at the Village, and you're just too good for me. But I really appreciate your candor, your experience. Known you a long time. You do great work, and really thank you for being here.
And thanks for having me, Walter. Keep it up.